Okay, this is Module 5 of accounting. Now we're just going to go over regular T accounts. So as you can see here, as a bookkeeper of Parker's Plumbing, you have access to complete the entire accounting cycle for the following information. January 1st, Parker invested $14,000 cash and $9,000 worth of snow equipment into the company. As you see here, Parker is the owner, so he invested $14,000 of his own money into the company. So we can see here, typically with T accounts, it's a lot easier to do it in Excel. To move over here, so you can see here. So owner's equity is a credit account increases. So you will credit owner's equity and you will debit cash into the company because you use cash into the own company. Now for the equipment, you will debit $9,000 for equipment and credit cash for $9,000. And we'll go back here. Paid rent for 5 months in advance for garage space for $3,500. So anything in advance says here paid rent in advance, so it's prepaid. So he prepaid 5 months for the company. So what you do is actual cash outlay of $3,500. So a credit is reduced to cash, so you credit cash and you'll debit prepaid rent. However, as a month passes by, you'll take 1/5 of that expense out of prepaid account. So you would debit $700 for prepaid rent, rent expense, and you credit prepaid rent, which you can see here, these two accounts. This is reducing this. So the balance in the prepaid account, if you add these two, is $2,800 at the end of the month. Okay? So you can see here, you can follow the same logic through the different transactions here. And we're just going to go to the last one. So it says, paid phone bill for $200. So we go to the last transaction. So you have telephone expense, which is a debit because you incurred that expense, and you'll credit, which is the other side of the T account entry, cash, which is cash coming out. So as you can see here, the way I label this T account, typically the T account would only be this section here. However, since I'm doing it in Excel, I like to use something called a pivot table, which is a lot easier for me to create financial statements. So you can see here I labeled each account within its own category. So owner's equity belongs to equity, cash belongs to assets. Then over here, the type of financial statement, equity, assets, that's all the balance sheet. And you have your income, your expense, which is on your income statement. So what I do is I highlight the entire thing, insert, let's see what it says here. Just wait for a second while my Excel responds. Okay, it's waiting. However, while I'm waiting on this to respond, so you can see here, these are pivot table. You click insert, pivot table, which you see here. So with the pivot table, you're able to determine your income statement, which is this filter here, and your balance sheet, which is this filter here. So you can see it adds up your entire activity. So you can tell here your net income is $8,600. So we come over here and then add those balance sheet items up from reading this. All your assets total 34. Equity plus your net income gets you 34, which balances out. And there you go. That answers that.